Welcome to the deep dive. We're jumping straight into some pretty interesting source material today.
Yes, we are. We're looking at Nvidia's latest financials, Q1 for their fiscal year 2026.
And our goal, as always, is to really unpack this press release for you, pull out the key numbers, the important insights.
Exactly. So you can get the main takeaways quickly without having to, wade through all the corporate jargon.
And this quarter, well, it wasn't just straightforward good news. There's definitely strong performance under the surface.
But also a pretty specific and actually quite significant challenge they had to deal with. It shows up in the numbers.
Okay, so let's dig in. Where do we start? The overall picture for Q1.
Yeah, let's do that. So the quarter ended April 27th, 2025. Top line revenue came in at $44.1 billion.
Wow, $44.1 billion. That's massive already. And how does that compare to the previous quarter?
It's up 12% from Q4 of fiscal 25, so solid sequential growth.
And year over year, I imagine that's where the really big number is.
Oh, yeah. Compared to Q1 last year, revenue was up a huge 69%. Just staggering growth, really.
69%. Okay. But when we talk Nvidia growth these days, there's one segment that's really the story, right?
Absolutely. It's all about the data center. That's the engine here.
So how much did data center bring in?
For Q1 fiscal 26, data center revenue was $39.1 billion.
Okay, so $39.1 billion out of the $44.1 billion total. I mean, that's basically the whole story almost.
It's a vast majority, yeah. And the growth there is, well, it's even more pronounced.
How much?
Data center was up 10% from the previous quarter, Q4, and year over year, up 73%.
73% growth in their biggest segment. That's hard to wrap your head around.
It really is. And the CEO, Jensen Huang, he commented on this, said global demand for AI infrastructure is, quote, incredibly strong.
Makes sense. He also mentioned their next big thing, right? The Blackwell AI supercomputer.
Yes, the Blackwell NVL72 said it's in full-scale production now and shipping. That's a key driver for future growth.
He also gave an interesting stat about AI usage, didn't he? Something about inference.
Yeah, that AI inference token generation, basically, AI actually doing stuff like writing text or making images, has surged tenfold in just 1 year.
Tenfold. So the demand for the output of AI is exploding, which drives the need for more of NVIDIA's hardware.
Exactly. And he expects that demand to accelerate even more as AI agents, become more common.
He also framed it bigger, saying countries now see AI as essential infrastructure, like electricity.
Right, and that NVIDIA is positioned right at the center of building out that infrastructure globally. It's a very powerful narrative for them.
Okay, so the core demand picture is incredibly strong, but as you mentioned, there was this headwind.
Yes, a significant one, tied to geopolitics, and it hit the numbers this quarter.
This involves their H20 products, right? The ones sort of tailored for the China market under existing rules?
That's correct. So the press release states that on April 9th, 2025, Nvidia got word from the U.S. government
What was the news?
that an export license is now required for shipments of those specific H20 chips into China.
Ah, okay. So a change in requirements for a product specifically designed for that market, mid-quarter.
Precisely. And this wasn't apparently required for H20 before, so it was a sudden shift.
And the immediate effect.
Well, demand for H20 basically dried up pretty quickly as these new requirements came into play.
Which obviously has a financial impact. How did that show up in the Q1 results? This is where it gets a bit tricky, right?
Yeah, it gets a bit nuanced. The big thing is they took a charge, a $4.5 billion charge in Q1.
$4.5 billion. What was that charge for specifically?
It was related to excess inventory of H20 chips they'd built up, and also purchase obligations, commitments they'd made to buy components for H20.
Okay, so stuff they had already made or committed to buy that suddenly became much harder to sell because of the new license rule.
Exactly. They were kind of stuck with it or couldn't easily use it elsewhere.
And the report also mentions sales before the change kicked in.
Right. It notes that before April 9th, H20 sales were actually tracking at $4.6 billion for the quarter. So it was a significant product line.
And then there was revenue they just couldn't ship.
Yes. On top of the charge, another $2.5 billion worth of H20 revenue that was ready to go just couldn't be shipped in Q1 because the licenses were suddenly needed.
Wow. Okay, so that $4.5 billion charge plus the unshipped revenue, that must have hit the reported profit margins hard.
Absolutely. If you just look at the headline numbers, GAAP gross margin was 60.5%, non-GAAP was 61.0%.
And how does that compare? Because Nvidia usually has really high margins.
Well, yeah. Compare that 61% non-GAAP to, say, 73.5% the previous quarter, or nearly 79% a year ago. It's a big drop.
Right. Just a quick reminder for everyone, GAAP is the standard accounting. Non-GAAP often adjusts for things like these one-off charges.
Correct, and that's the key here. The press release also gives us the adjusted numbers without that $4.5 billion charge.
And what did those look like? This should show the underlying business health, right?
Exactly. If you back out that charge, the adjusted non-GAAP gross margin would have been 71.3%.
Okay, 71.3% adjusted versus the reported 61.0%. That's a huge difference. It shows the core operation was still very profitable.
It really does. Same story with earnings per share. Reported non-GAAP EPS was 0.81 cents, which was down.
But the adjusted number.
Adjusted non-GAAP EPS, taking out the charge and related tax effects, would have been darn as 96 cents.
So again, much stronger underlying performance than the headline number suggests.
Right. It confirms that this wasn't like a fundamental problem with the business efficiency itself. It was this very specific, very real financial hit from the H20 regulatory change and the resulting inventory issue.
A clear example of how geopolitics can directly impact the financials, even for a company firing on all cylinders elsewhere.
Definitely. Okay, so that covers the main data center story and the H20 situation.
Yeah.
But Nvidia isn't just data center, right?
No, absolutely not. Let's touch on the other segments. What about gaming and AI PC?
That segment actually had a record quarter. Q1 revenue hit $3.8 billion.
A record for gaming. And the growth.
Pretty spectacular, actually. Up 48% from Q4 and up 42% year over year. Really strong momentum there.
What's driving that? Any specific products?
Yeah, they mentioned new GPUs, the GeForce RTX 5070 and 5060, but also the continued push of their DLSS tech.
Ah, DLSS 4. That's their AI upscaling for games, right? How's the adoption?
It's now in over 125 games. They listed some big upcoming ones like Black Myth Wukong, Doom, The Dark Ages, Star Wars Outlaws.
So having it in that many games, including major titles, what does that really signal for Nvidia? Why is that important?
It means it's becoming almost a standard feature developers expect to include. It gives Nvidia users a real performance boost and better visuals in a lot of games. Makes their cards more attractive, drives upgrades.
And wasn't there news about Nintendo?
Yes, big news. The upcoming Nintendo Switch 2 will be powered by an Nvidia processor, and it'll feature their AI DLSS. Hints at potentially 4K gaming on a handheld. That's a huge win.
Definitely expands their reach in gaming. Okay, moving on. Professional visualization. How did that segment do?
ProViz brought in $509 million in Q1.
Which was flat compared to Q4, but still up nicely year over year.
Yeah, flat sequentially, but up 19% compared to last year. Solid growth.
What were the highlights there? New products?
New workstation GPUs, the RTX PRO Blackwell series, also these personal AI supercomputers, DGX, Spark, and Station. But a key thing was Omniverse integration.
Omniverse, their platform for building virtual worlds, simulations.
Exactly. Major industrial software partners like Accenture, Ansys, SAP, Siemens are integrating it.
And the goal there is industrial digitalization with physical AI. What does that actually mean for, say, a manufacturer using Siemens software?
It means they can use Omniverse to build super accurate virtual copies, digital twins of their factories, their products, whatever.
Okay.
And then they can simulate processes, test layouts, even train robots in that virtual world before doing anything physically. It speeds things up, cuts errors, enables way more advanced automation in real-world industries.
Got it. So applying that simulation and AI power to heavy industry. Makes sense. What about automotive and robotics?
That segment reported $567 million in revenue for Q1.
How did that track?
It was actually down just a tiny bit, 1% from Q4. But year over year, still really strong growth, up 72%.
72% year over year is huge. What's happening there?
Collaborations are key.
Yeah.
Like with General Motors using Omniverse and their Drive AGX platform for vehicles and factories. Drive AGX is their autonomous driving computer system.
They also mentioned safety systems.
Yeah, Halo's a unified safety system.
Oh.
And then there's a big push into robotics.
Right. Humanoid robots seem to be a focus area.
Very much so. They launched Isaac GR00C N1 and N1.5. These are foundational AI models specifically for humanoid robots, plus tools to create synthetic data to train them.
So they're building the AI brains for these future robots.
Essentially, yes, using their Blackwell systems to develop them. Also new Cosmos world models and tools to help robots understand and interact with the physical world.
So it's not just chips for cars anymore. It's platforms, AI models for cars, robots, the whole physical world interaction.
Exactly. It's a clear strategic direction. Take that core AI strength from the data center and apply it to making physical systems intelligent.
Okay, so that covers Q1 performance across the board. Massive data center growth, the H20 hit on reported numbers, but strong underlying results, plus progress elsewhere. What are they forecasting for Q2?
For the next quarter, Q2 fiscal 26, they're guiding for revenue of $45.0 billion, plus or minus 2%.
45 billion. And did they specifically mention how the H20 situation affects that number?
They did, very explicitly. They stated that the $45 billion outlook reflects an anticipated loss in H20 revenue of about $8.0 billion because of those export control limits.
$8 billion in lost H20 revenue expected in just one quarter. That really quantifies the impact of that regulatory change, doesn't it? And the size of that specific market segment for them.
It absolutely does, puts it in stark perspective.
What about margins for Q2? Are they expecting a rebound now that the big inventory charge is mostly done?
Yes, margins are expected to bounce back significantly. GAAP around 71.8%, non-GAAP around 72.0%, plus or minus 0.5%.
Okay, so that's much closer to that adjusted margin we calculated for Q1. Confirms the inventory charge was largely Q1, but the lost H20 revenue is an ongoing factor baked into the Q2 guidance.
That seems to be the right read. They also mentioned they're still aiming to get gross margins back into the mid-70s range later this year.
And operating expenses, still investing heavily.
Looks like it. Q2 OPEX expected around $5.7 billion GAAP, $4.0 billion non-GAAP. And for the full year, they expect operating expense growth in the mid-30% range. So, yeah, continued heavy investment.
All right, that's a ton of information we've gone through. If we had to boil it down, what's the single most important message for you from these results?
I think the core message is just the incredible underlying strength, driven by that seemingly unstoppable demand for AI infrastructure in the data center. That's the main story.
But you have to look past the headline numbers this quarter because of that H20 charge.
Right. The reported numbers were definitely impacted by that $4.5 billion charge. But if you adjust for it, you see a business still operating with really strong profitability and momentum.
So the H20 issue is real. It had a material impact in Q1, and it will impact revenue going forward. That $8 billion Q2 forecast makes that clear. But it's a specific geopolitical issue, not a sign the core AI business is weakening.
Exactly my takeaway. And while data center is king, you also saw that record quarter in gaming, and the strategic moves in Pro Vs and auto robotics show they are building for the future beyond just the data center.
It makes sense. Any other small details we should mention before we wrap?
Just the usual dividend announcement, $0.01 per share, payable July 3rd to shareholders on record June 11th. Pretty standard stuff.
Okay. So, a fascinating quarter for Nvidia. Huge underlying growth, especially in AI, bumping up against the realities of global trade regulations.
Yeah, rapid growth meets a specific, significant geopolitical hurdle. A tale of two forces almost.
Which leads us to a final thought for you, our listener. Considering this massive demand for AI infrastructure that Nvidia is writing, alongside the very tangible impact we saw from export controls like the H20 situation, costing them potentially billions in revenue, how should companies in these critical tech sectors navigate this tension? How do you balance chasing huge global opportunities against the rising complexities and risks of geopolitics and trade roles? And what does that projected $8 billion quarterly loss in H20 revenue really tell us about the potential scale of these restricted market segments? Something to think about.